Hey, Think Realty, thanks so much for being a part of the podcast today. My privilege to be the host, Eddie Wilson, the founder of Think Realty, founded it in 2013. Excited for our guest today, but before I jump into our guest, I want to say a quick thank you to our podcast sponsor, which is brought to you by Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you're maximizing the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. That's realpropertymgt.com. Our guest is one that you've seen many times. He has the title of being the most listened to podcast guest. So you're going to love this episode. And our guest today is Aaron Chapman. Thanks so much for being on the show.
I didn't know I had that title.
Hey, well, we gave it to you because it's real.
Right on. I need to put that somewhere.
And it's because you say the things that no one else are willing to say.
And I always wondered why people aren't willing to say certain things.
Yeah.
What stops you
Social
from
norms.
allowing what's
Social constraint.
well, exactly. I mean, it's that we all follow this costume of conformity.
Yeah.
And what's interesting about that costume of conformity, you have a person who's one way at work, one way at play, and one way at church. Mm-hmm. And I had a guy come up to me one time at church, and he goes, "You know."
You go to church?
I do go to church.
Okay.
And he says you are the embodiment of integrity.
I've actually heard your stories. I've actually heard that you taught a Sunday school class and you swore in it.
Well, all the time. There's an over-under every time. So I do teach at church. That's one of the things they want me to do. And it's there's always a running thing. I'm like, here's the thing. I'm not going to go as high as you. I can't remember how I ran that whole statement all the time.
The over-under.
But yeah, as far as their thing, you're all going to be disappointed sometimes.
Yeah, it's never as much as you thought it would be, and never as little as it should be.
Never not going to be none of it, right?
Yeah.
So I've always had a really good time with that because there's a way to strategically place words and strategically place conversations to get the maximum effect. And I think people really walk away from that. We both know Lee Arnold, right? Mm-hmm. Lee's a great dude. Awesome. He's Christian, preaches a lot. We see eye to eye on a lot of things. But he's like, Aaron, I need you to you don't have to swear like that. I said, but sometimes people don't hear what you say until you do.
Yeah.
It's like, but it's interesting. We have a great conversation.
My business partner, Andrew Cordell, you know him. Mm-hmm. Andrew drops more F-bombs on the stage than any other person I've ever heard. And he gets more flack from dropping F-bombs on the stage. But yet I guarantee, and why I don't ever say anything to him, I guarantee that a majority of the audience is listening far more intently to him than they are to me.
Well, 100%.
And I just can't bring myself to drop the F-bombs.
Not to that level.
Not even once.
Sometimes. Really. I didn't. So I haven't listened for it. Yeah. I just know you're on the stage with Andy Cordell, so they stuck.
Yeah.
That's just how it works.
It works.
Well, right on. So where else are we heading today?
So if you don't mind, just to walk into where we are today and what you are up to, because you went through a major change. All of us have known you to be a conventional mortgage broker, specific in the real estate investment space. That's kind of what you've been known for. And you've kind of hung your shingle attached to one company and you just moved to another, which has to have a lot of implications, but there must be a massive reason why. And I'm just curious, for you to talk us through that and why.
Cool. So we'll start there because it leads to all the other things. Been in the industry since '97, and I've force cut my way through things, markets, changes, real estate investors, and it's been my direction. Been with one firm for nearly 10 years, and next month it'd be a decade. Amazing people, great people. They were like family. Yeah. But you could also walk in and talk business. It wasn't the kind of family where they're going to screw you type family. And it just got to a point we had a product demand that we just didn't have in house, and we were trying. We had to broker it. When I had to broker 70+% of my pipeline, and you don't have control over how that deal gets done, and it gets more increasingly difficult when the brokers you're working with. The last straw was I sent a pair of files for one client to one shop brokering it to them. They gave a file to one file to a different underwriter and then another underwriter. You get two different viewpoints, two different sets of conditions, and then you have to condition the other one the same. And it became this big wheel of mess. And the other part of it is it cost me probably twice as much to manufacture that way, but I made a third less revenue off of it. And we're just running ourselves into oblivion.
Sure.
So I decided, okay, I'm going to get my head up and look around. I looked around at various different companies, and there's one that had a product load that seemed to be perfect. And what was really awesome about it is they didn't even know what they had. It's a great product. They're selling the hell out of it, but I don't think they realized exactly how powerful that product was. That worked great in my space.
Right.
So we moved half the team in January, and I'll just tell you, for the last 2 months, I could climb in bed with my shotgun and sleep with the muzzle on my mouth every single night. It was that miserable. Moving a team that size is significant. And I didn't anticipate how hard it was going to be. But what you had was 4 people, 5 of us moved with a team of 16. We thought, okay, we'll just kind of get things going, but you have to move offices, licenses.
Sure.
You have to get all the licenses up and running. You then have to move all your clients. You then have to start originating new loans. And when you're doing all the background work, getting it built and getting it all settled in and all the technical stuff and all the licensing, but now we're trying to add the new loans. Well, I usually have 16 people help us do that. There's only 5 of us. So I'm doing 4 jobs. This one's doing 4 jobs, but we're also doing an environment and an ecosystem we've never done before because it's so damn different.
Sure.
And so when you add that all in, the stress levels are through the roof. And then we had the next month, we brought the rest of the team on, and we're still trying to come up the curve. So we're going through a very, very intense process of this breaking down the assembly line into granular levels. And that's what we're in the middle of right now. But I think we're going to come out the other side better, hopefully more efficient, but a much better product for the investment space. We're still conventional lenders,
right?
But now I have a product that gives us something that people have been wanting for years, and now we have it.
Yeah. What is that product? I mean, so you've got conventional lenders who are still, you're a conventional lender going to a group of real estate investors who typically start to shy away from conventional lending because, historically it's just difficult. It's more difficult to get your loans processed. A lot of conventional lenders don't want it. So what is that product?
Yeah, so you're talking more paperwork, more headache. Do I qualify? Do I not qualify?
Usually it's cheaper money,
stuff.
right? I mean, it's usually cheaper.
It's definitely usually cheaper money, and that's why they'll do it. And everybody talked about their 10 golden tickets. Well, now those same investors can come to me, not have to give up any tax returns. I don't have to look at their income. They can put their income down. They can form a brand new LLC. It doesn't have to have any history whatsoever. And as long as the property is generating enough revenue to pay for the principal, interest, tax, and insurance payment that we put on it, I can close that loan. They need to have a credit score that works and have to have the assets. That's it. And we slap those deals out.
Is that, so that'd be equivalent to a DSCR loan?
It's a DSCR loan. It's a debt service coverage ratio loan that is 30 years fixed. 2-year LLC doesn't report to your credit.
It doesn't.
So you can do unlimited. And let's say we know that the market can be a fickle place, right? So sometimes these things come in and out of availability. We remember when COVID hit, we knew DSCR lenders who couldn't fund a loan to save their life during a certain window.
Wouldn't happen.
But with this, it preserves your Fannie Freddie 10, so I can flip it back over there and keep going with those. So I tell people now, don't fill up your Fannie and Freddie. Use the hell out of this. Your LLC, it's not on your credit, it's fixed for 30 years, and the interest rate is comparable, if not better, than Fannie and Freddie right now. I can get a lower rate on a $300,000 duplex today with 20% down than I can with a 25% down duplex with Fannie and Freddie. And it's, again, to your LLC. So I wouldn't say it's the holy grail, but it's its first cousin.
It's close,
because that's what everybody's wanted. Why can't Fannie and Freddie do all of these loans for our LLC? It's still me. Now I can. And the rates match. It's amazing.
That is awesome. And that's always been the big issue, right? As an investor, it's like you don't want all that personal liability. You don't want it tied to you personally. And I know that it still to a degree is. I mean, it always is.
It's always
but it's just it's nice to have that step removed,
And we've done a step further now. I've partnered with a national law firm and a CPA firm that will now sit with my investors, and we will have a package built for them, one-time fee, as many LLCs as you want, you pay them, and they will structure exactly as we need it to be for your financing for whatever house. So it gets done, it's not an error, so you have all the things you need. You have your operating agreement, you have your formation docs, you have your EIN, you've got the minutes that you need to be able to show that you have your resolution to borrow, all the proper documents that you need that most lenders don't even ask for because they don't know they need it. And it's not so much that they don't know they need it, they don't know that you as an investor need it to have a really solid, secure business. And it's not only cool that it's the law firm is building this exactly as it needs to be done to make you now a real estate investor with the businesses. You have your LLC that you buy the house with, and if you're going to do BRRRRs, you now have the LLC that you can loan the money to yourself with. and get your promissory note and your deed of trust, and then I just do a rate and term refinance. And I have that construction already done, pre-done for people. But then they also have the CPA firm in there that talks to your attorneys and sets you up properly.
Yeah.
So now you're not having to now unravel what this elaborate crap this other attorney came up with. For now you have your local CPAs like, I don't know what he just did here.
Right.
And sometimes when people go out of this ecosystem and seek out this attorney that they've heard of, they get handed things that are very elaborate, but then you can't lend to.
Right.
Because it's too elaborate. No lender is going to do that.
Sure.
So we're setting up where you can get started and you have a very, very professional system. And we're doing it all in one space. You got that, you got your insurance, you got your loans, we've got now national hard money. We've got a lot of really cool things.
Yeah, that's awesome. Very cool. I mean, it seems like quite the evolution. I mean, it's like from where you were to now where you're headed seems like it makes a lot of sense.
Oh, the direction is, I equate that to, I was driving around a 67 GTO looking cool and full and awesome for a long time, but now I'm sitting in a 747. I'm still trying to figure out what that fucking button does.
Yeah. Yeah.
Right? So
Yeah.
that's the thing we're in the middle of. But
Right.
look what we can do. When you
Yeah.
can pack that many people in a 747, we can go a long ways.
Sure.
But before, I'm accomplishing one thing at a time. Now we can do a lot of things at one
Yeah.
time. And I think the biggest drive for me is you have so many real estate investors out there that don't know where to start, and they're getting started with the theory of somebody else that's never applied it,
Right.
that just wants to get paid for giving them their so-called class. I'm sick of it. I'm tired of people getting charged for something that they never get anything out of.
Sure.
I'm changing the landscape. I'm coming from the lender's perspective, because if you go about it all the theoretical perspectives and you don't get the loan, you don't have anything.
Yeah.
But if you know you can get the loan and then build all the other things around that, you have everything.
Sure. Yeah. So where do you think the market's going? We're still, you're talking a lot about the changes in the kind of economic marketplace, but also the lending marketplace. But as a nation, it seems like we're kind of stuck in the middle. It doesn't seem like we're doing anything too exciting. We're not necessarily, it's not dipping. It seems like we're right in the middle. It seems very stable right now. One of the podcast guests, he called it vanilla. He said, it just feels like we're in a very vanilla space. Where do you think we are, and where do you think we're headed?
I think we're going to play in this space for a little while. And the reason being is I've stood on the stage here, I think really quite a few times. I've stood on other stages that you had curated where we've shown the charts, the mortgage-backed securities, and what's driving the market, and why we're not going to see interest rates going lower than what we saw this last September.
Sure.
That's our lowest point. And unless the Federal Reserve decides to go, and we know they're not going to, not now,
Right.
start the quantitative easing again, we're stuck in this rate range right now. There's no amount of movement that the Fed can do that's going to influence that. It's going to take a stock market crash and an enormous amount of flood of capital to bring those rates down. But what we did notice over the last month, how many times did we see the stock market take a monster header into the concrete?
A lot.
A lot.
Yeah.
How much money moved over to bonds? Barely any.
None, yeah.
It hardly moved the needle.
Yeah.
The Fed dropped the rate 3 times. What did it do? It brought the rates up. It pushed the bonds down. These are all inflationary things that have happened, and there's not enough value in MBS at all for anybody to take their money from stocks and park it there. Because they're at their best, they're getting 5.5% return in an economy that we're still seeing over 8% inflation.
Yeah.
I'm not the CPI, the PCE, all that stuff,
Right.
those aren't accurate.
They're not real.
So I think we're heading sideways for quite a bit. Till everything stabilizes and people feel more, more confident in the economy. They're scared of what tariffs are because we've never talked about it a lot as a country.
Sure.
But the smarter people understand this is going to be very, very good for us. And I pray it's going to be as good as we believe it's going to be. And I pray that it also bleeds down to the tax side of it, because you and I need to pay a hell of a lot less.
Right.
So there's those particular things. But I think that the markets itself, what we may see, this is just a thing that I'm thinking might come in the next little bit because of the change of the philosophies of the current administration, is we might start seeing some of those foreclosures start coming about that's been held off in the FHA world.
Yeah.
FHA has, I think it was 14% or 17%, something like that, or in some form of default. That's over 1 million loans in
That's a
default
lot.
with FHA.
14%?
14%.
Wow.
And that's because, and I could be off on that number, so if there's somebody out there who's like, he's wrong, so everything he said is crap. No, I'm off on a percentage. But it's over 1 million, I know that, because they've been carried by the Biden administration and
Sure.
the way that particular system was set up. But that's going to stop. And when that stops, everybody's like, is that going to crash the housing market? No, investors are going to pick that up.
It's a domino that...
And they have built-in renters. They may not rent the same house, they're just going to trade houses.
Sure.
So it's back to 2008. I don't think, and it's not going to be as bad as 2000, nowhere near it. But we noticed in 2008, you're around there, I was around there. There's so many people in my space that weren't around in 2008. And if you're a real estate investor and you're talking to a lender that did not see 2008, they don't know what they're talking about at all. Because they talk about cyclical markets. We've not seen a cyclical market in 15 years.
Right.
And so, and we continue to evade the cyclical market with economic policies by the Fed.
Well, we really haven't seen a cyclical market since 2008, right?
Yep.
Like, I mean, because that was a deep dive, when the market crashed. It really it rebounded, but it took a long time to rebound. And then we went to an extreme high. And then we had a hyperinflated market that, is essentially inflated by cash that was printed, and so then it created this cliff, and it's like we still haven't seen the fall off yet from that cliff that was created.
100%. And again, people don't understand how that works out, how the influx of cash affects the value of the dollar. So I brought something as an example for people to hopefully try and make that work. So I'll ask you, what do I got right here?
Okay. It's a $20 coin, 1888.
1888, 20 bucks in 1888. What's interesting is that's minted for $20. It's an ounce of gold. What is this?
That's a $20 bill.
It's 20 bucks. Are they the same?
No.
No. So what's an ounce of gold today?
Is it 800?
It's 3,100.
3,100. Wow.
$3,100 for an ounce of gold.
Yeah.
I see you're not in precious metals.
I'm not in precious metals at all. Maybe I should be.
I think you should be, because when you're thinking you're paying $100, it's $3,100.
Yeah.
But to buy this specific coin, it's like 5 to 6.
All those little 8-ounce bars I brought back from Honduras sound like a really good idea.
It's a good thing you had big shoes on that day, right? What's interesting is this takes, there's $3,000, $3,100 just to get the metal. That's not even the minting. The minting of this is probably $5,000-6,000.
Right.
But it says it's worth this. What's crazy is you could go back into the department stores of the early 1900s, Woolworths, that kind of thing.
Sure.
Get a hand-tailored suit, a hat, a shirt, a tie, a belt, a pair of socks, a pair of shoes for 20 bucks.
Yeah.
I can't buy these damn socks. I know you don't have the problem.
Yeah.
I can't buy these socks for 20 bucks.
Yeah, right.
These are $35 freaking wool socks.
Yeah.
But what's interesting is I can buy all the things I said. I can even buy Eddie Wilson style clothes with an ounce of gold.
Yeah.
Right? I can completely outfit Eddie freaking Wilson and Andrew Cordell with an ounce of gold.
Yeah.
But what's interesting is it's not that the gold has become more valuable, and it's not that the clothes have become more expensive.
Right.
It's that this has been worth less because there's so damn much of it.
Sure.
Now, if they printed this to the level that this was available, this would still be equal.
Still be the same. Yeah.
That's the problem that we have right now. So a lot of the people don't understand that when I say the best part of the deal is the loan, is because when you're paying back that loan, you're paying it back with this.
that.
When you borrowed it, you got this because you got a hard asset, that real estate. But you pay it back with this.
That only
over
appreciates
that time,
too.
And it only, just like this did.
Yeah.
This is basically like a house. It's just been
Right.
appreciating slowly because this has been depleting.
Yeah.
So as you're paying it back with this, you actually give back less than what you borrow from the bank. So people's like, I know there's people present on, let's get the bank out of the mix. Not when it comes to your mortgage.
Sure.
Borrow very high, leverage long, and pay off slow. That's what you need to do. You need to do. So that's kind of the thought process I need people to really wrap their head around. This inflation is not a bad thing when you're in the market, especially in hard assets. It's a very bad thing if you're a consumer.
Right. Or if you're playing in assets that aren't hard, and I've seen a huge movement of people moving from non-hard assets into hard assets. It's like you've got the stock market, for instance, taking these massive, headers into the concrete, as you said, and I still think that there's a lot of that to come, and I think there's a reason that. I think it was in the last 20 days, you have all these massive CEOs and huge people coming to the place where they're selling their shares. I think it was American Express's CEO sold 35% of his shares in the last 20 days. And you start just going down the list. Netflix, he sold like 25%. Just like all the CEOs, it's like, why are these guys all of a sudden dumping their stock, right? It's like they know that something is coming. Yeah.
They know what's happening. And hopefully, my interest rate on my American Express card follows their stock.
Yeah, right. Yeah, that'd be great.
They're charging the piss out of it.
They're charging a lot. Yeah, and again, it's like we know that the hard asset will always increase in value over time. Like it may have periods of time where it flattens, but for the most part, it's always going to increase, especially in the housing market.
100%. Well, the other benefit, okay, so we're talking precious metals, but I can't leverage this precious metal.
Right.
I can't borrow money against it. I can't rent it to you and pay for it.
Right.
Well, see, that's why housing is such a better thing.
Yeah.
Even buying a car and doing a Turo thing is slightly better than holding gold because you can't do it. You can't eat the gold, you can't whatever.
Right.
My opinion, if you want to get into precious metals, copper jacketed lead. If you add a ton of gold and add a ton of copper jacketed lead, I will own all the gold too.
That's true.
Right? So there's that need. But hard assets, especially real estate, something you can rent out that's going to appreciate. And I'll be on stage tomorrow and I'll get deep into that as to how that works and how to look at a deal. And it's not about cash flow. It's not about cash on cash returns. Those are the cherry on top of the sundae. There's a lot more in that bowl.
Yeah. So your market overview, market outlook is that we'll still stay in kind of a similar space that we're in today.
I think right now we're looking at the same for quite a while.
And then after that, based on essentially, if I could kind of read between the lines and what you're saying, depending on inflation and the price of capital will really determine the movement in the marketplace.
100%. Because if you get if we go into a direction where they change monetary policy, they decide they're going to flood the markets with capital again, like they did in 09, then we're going to start seeing more inflation. We're going to start seeing more problems as far as that's concerned. Cheap money.
And cheap money causes people to buy.
Exactly, and pushes the price of housing up. And I tell everybody, if you're sitting here waiting for the rates to go down, if they do, let's say Aaron Chapman's wrong, I don't think he is, but if he's wrong, you're now paying 12% more for the house.
You're still not paying more.
You're not winning.
Yeah.
I think this is a very good place to be. 7.5% on the average for a real estate investor is a very good rate. What sucks though, they're paying 7.5% on inflated price of structures because of what happened in the last decade. If it wasn't for that, and we maintain that level, we would still be seeing the average house play at price in the 200s probably, maybe even very low 300s, and we have these 7.5 rates and nobody would care. But we saw that hyper pricing, and that's why it's hurtful. That's why our children are having a hard time buying. That's why I set up the family trust and the trust buys, and the kids rent from the trust. And that's another elaborate thing that I will get into for my investors that will help you set up with this law firm. We're going to do more for you than close a freaking loan. So when you're shopping us for rate, just know you're losing out on everything else.
I've far gone away from shopping for rate a long time ago. To me, it's about the deal. It's about does the numbers pencil out?
100%.
And is this an asset that I want to hold for 30 years? Like I stopped looking at what can I make off this asset short term, and I've gone away from that because those are the deals I've lost on. Like those are the deals that I expect this great return, and then all of a sudden,
and the great returns never are there, right?
They're never
it's really, really crazy. You get this awesome pro forma, amazing performance. It's gonna be awesome. 1 out of 20 still
it's not
eliminates all of them. You could have just walked away from all 20 and you'd still be money ahead.
That's where I got to, is after you do, let's say 1 out of 20 has this amazing return, and then you look at these like tried and true long-term deals, they far outweigh the benefit than getting 1 out of 20 correct, So
yeah, they definitely outperform, because the 1 out of 20 you're going to have other expenses you got to deal with. Even with the other 20, that's going to kill you. So the other thing is, I just tell everybody, like you said, if you have to make the rate to make the deal work. If the rate is, then you don't have a deal.
You don't have a deal.
It's not a deal. You're market dependent, and that's never a deal. And you're not a real estate investor. You're an opportunivore.
Opportunivore.
Not that that's a bad thing. Opportunity knocks sometimes. You want to be ready to take care of it. But if that's all you do is you're running around for that, you're not going to win anywhere.
Great. How many, I'm sure that a lot of people would like to kind of follow you, and I know you put a lot of great content out there, so how could they get in touch with you? Or
AaronChapman.com still works. It went down for a little while. It dicked up my Google algorithm, but it's now up and running again. I got the YouTube show. You go right there on the media section, you subscribe on the YouTube. We're going to start enhancing the hell out of that here soon. Right now it's still just talking about the rates twice a week, but we're going to start getting really heavy into enhancement to make sure there's plenty of data, plenty of content on how to be successful as a real estate investor with all the spokes in the wheel I just put together.
It's great. Yep, highly recommend if you're in the Think Realty world that you check out Aaron Chapman, see all of his stuff. He puts out way more content than we do, and he puts it out a couple times a week, and you can get on his email list and get it sent directly to you, and so appreciate you.
I got a book coming out soon that you want to get on the list of that sumbitch too. I haven't put the list out yet, but that's going to be ridiculous.
I have gotten a sneak peek at this book and highly recommend it. It's a great book, and I think I've even written a foreword for it.
Not yet.
Not yet. You're waiting on it.
I was.
Yeah. Okay.
But we're almost in print, so you got.
It's too late.
I don't know if it's too long, too late, but you got a window like that. It's titled Redneckonomics, and it's
very good.
Basically, it's the economy of an ass beaten, and it'll be defined in the book.
Yeah, it's very, very good. Yeah, make sure you get on the list, and make sure you're ready for that to come out. All right, very good. One last thank you to our podcast sponsor, which is Real Property Management. Real Property Management. Working with the right property management company can put more money in your pocket, not less. Real Property Management provides a higher standard of property management to make sure you maximize the return on your investments. Experience the real difference with Real Property Management. Visit realpropertymgt.com. And one last thing, coming up on August 13th, we've got our real estate summit, which is virtual, the Think Realty Virtual Summit. We are doing, this will be our second year. Last year we did it, and it had such a huge turnout, and all the people were super excited with the content we brought, because many of you wanted to come out to one of our conferences but have never been able to come out, and so we've wanted to provide this for you virtually. You're going to find the confidence to succeed and grow your business this year, insights into this, how this year's will impact rates and inflation, understanding market predictability, and then also access to tangible investing strategies based on current market data. We're going to be teaching multifamily, single family, self-storage, a bunch of different things. So make sure you get your ticket by going to thinkrealty.com/virtual, and we'll see you there. Thank you so much.